The chief of the U.S. Federal Reserve says the unemployment situation in the United States is still a grave concern. Bernankes says the jobless rate is nearly unchanged from the beginning of 2011, and less than half of the 8 million jobs lost in the recession have been restored. The Federal Reserve announced it will resume its policy of pumping more money into the economy. The Fed will buy $40 billion in mortgage-backed securities every month. Crude oil futures jumped to their highest level in 4 months following that announcement. The Fed is already being accused of risking a runaway inflation with its previous stimulus programs. Bernankes also said the Federal Reserve does not have the means to offset economic shock from the cuts and tax hikes scheduled for the end of 2012.
Inflation will remain close to our To
discuss that a bit further, we're now joined by Mr. Webster Tarpley, who's an author and historian who's joining us now live via satellite from Washington. Mr. Tarpley, thanks a lot for joining us now. The Fed has announced that it will resume its policy of pumping more money into the economy. Will that be enough to stave off unemployment?
No, it cannot. Right now we have an economic depression in the United States and around the world, and the real unemployment in this country is much higher than the Federal Reserve seems to want to admit. It's about 30 million people minimum that are out of work, which is significantly more than the government estimates. The problem with the Federal Reserve is that they see their task as saving failed banks. We have to call them zombie banks because they're bankrupt entities that sit there, they absorb government and Federal Reserve resources, they don't provide investment, they don't create jobs, there's no plant and equipment or capital goods investment going on. But Bernankes thinks that his only job is to make sure that there's a constant flow of very cheap credit, 0% credit practically, to these zombie banks. Now the zombie banks don't go out and invest with that money. They speculate. They drive up the price of gasoline. They buy derivatives. They invest in collateralized debt obligations or credit default swaps. Mortgage-backed securities, by the way, are a kind of derivative. So it looks like the Fed thinks that the way you deal with an economic depression is to keep the price of mortgage-backed derivatives up by buying them at a rate of $40 billion per month. This simply cannot work. On the other hand, if they could take that $500 billion or so, they could use that to buy bonds from states that want to build railroads, roads, ports, water systems, public housing, canals. The entire infrastructure of the United States is approaching the point of thermodynamic breakdown. If you invested money into those things, you'd actually get a recovery. But that would mean going beyond the fiscal stimulus, which the government, the Treasury does, going beyond the monetary stimulus that the Federal Reserve is trying to do, a kind of a hot money stimulus, to what we would call a credit stimulus. In other words, $500 billion or $1 trillion at 0% over 100 years, and put that into infrastructure, you'd actually get a recovery. But that would mean not favoring the zombie banks in the way that Bernankes continues to do.
All right, we'll have to leave it there for now. That was Mr. Webster Tarpley, author and historian, speaking to us live from Washington. Mr. Tarpley, as always, we do appreciate your insight here on Press TV.